All right, let's talk about something we all just take for granted, our banks. I mean, we trust them with everything, right? Our paychecks, our savings, pretty much our entire financial lives. But what if that trust, that whole system, is built on a foundation that's, well, way more fragile than any of us think?
Now, I want you to really picture this for a second. You wake up, it's normal day, but your bank is just gone. It's not just some minor inconvenience. It's the moment the entire modern world just grinds to a halt for you. And the first signs, they'd be so small you might just brush them off.
You know, you'd probably reach for your phone first thing, try to check your balance, but you just get that little spinning wheel. Cannot connect to server. Annoying, right? You figure it's just a glitch, no big deal. I'll just grab some cash, you think.
But then you get to the ATM down the street, and the screen is totally dark. There's a piece of paper taped to it. Out of service. Okay, now that little knot of concern starts to form in your stomach. But you figure, hey, I'll just go to the store and pay with my card.
So you get to the checkout, you've got your stuff, you tap your card, and declined. You try another one, same thing. The cashier just kind of shrugs and points to this little handwritten sign you didn't even see before.
And right there, that's the moment it hits you. The whole system is down. All that digital money you thought you had, it's just numbers on a screen. And suddenly, the screen has gone dark. The only thing that matters now is the actual paper in your wallet.
Now, I know what you're thinking. This whole scenario sounds like something out of a crazy movie, but it's not. This is real. It's documented history, and it has happened in modern, supposedly stable countries that thought it could never, ever happen to them.
And look, this isn't some kind of ancient history lesson. We're talking about the United States during the Great Depression, sure, but also Argentina in 2001, Cyprus in 2013, and Lebanon just a few years ago. Freezing the entire financial system is a tool that governments use when things get bad. Let's look at what that actually feels like for the people on the ground.
So in Argentina back in 2001, the government created something called the corralito, which basically means the little corral. And that's exactly what it was, a cage for people's money. You could only take out a tiny amount each week. And all those dollar savings people had, the money they trusted to be safe, were just forcibly converted into a local currency that was absolutely collapsing.
And this quote, man, it just gets right to the heart of it. This wasn't just some line on a stock chart. It was a social catastrophe. It completely vaporized the life savings of an entire middle class. People who did everything right, who saved them money, and just got wiped out overnight.
Then you got Cyprus in 2013, and this was a whole other level. Instead of just trapping the money, they took it. They called it a bail-in. People with over 100,000 euros woke up one morning to find that a huge chunk of their money had been seized, just taken directly from their accounts to go save the very banks that had failed them.
So, how can this even happen? I mean, why is the system we depend on for every single thing, every single day, so incredibly vulnerable? Well, the answer is kind of baked into the very architecture of modern banking. The whole thing is basically built on confidence.
The secret ingredient is this thing called fractional reserve banking. Now that's a fancy term, but the idea is both the engine of our entire economy and, honestly, its greatest weakness. The bank doesn't just keep your money safe in a vault. Not even close. It keeps a tiny fraction of it and then lends out all the rest.
Think about it like this. You deposit $1,000. The bank holds on to maybe $100 and then lends out the other $900. That loan gets spent and then it gets deposited in another bank, which then holds on to 90 of it and lends out 810, and on it goes. Your one single $1,000 deposit has suddenly created thousands of dollars of credit out of thin air. It's a machine for creating growth, for sure, but it's also a giant house of cards.
So here's the absolute most crucial thing to get. We all have this perception of our bank as a vault, right? Like a super safe storage box for our money. But the reality is that the bank is a multiplier. Your money isn't just sitting there. It's been lent out again and again and again. If everyone showed up at once and asked for their original cash back, the whole system would just instantly collapse. And this quote just perfectly nails the dynamic of a bank run. You don't even need a real fire. All you need is the fear of one. The second a few people get spooked and start running for the exit, everybody else follows. And pretty soon the stampede itself becomes the disaster, trampling even the healthy banks that were perfectly fine a minute ago. And this all leads to a really, really uncomfortable truth. When that stampede for the exits begins, the people in charge, the government, the central bank, they have one primary goal. And it's not protecting you. It's protecting the theater. Now, here in the US, we all have this, right? FDIC insurance. It's the magic number that's supposed to let us all sleep soundly at night. Your deposits are protected up to $250,000. It's the ultimate safety net. Or is it?
Well, here's the question the system really hopes you never ask. The entire FDIC insurance fund is just a tiny fraction of all the insured deposits in the country. Its real function isn't financial, it's psychological. It's a placebo. It's designed to stop you from panicking in the first place.
So, let's just lay it all out, right? When a real crisis hits, the math is brutal. The government's #1 priority is system stability, keeping the whole theater from burning down. Their tools? Freezing withdrawals, bail-ins, capital controls. Your priority? It's pretty simple, getting access to your funds. And your tools? Well, you don't really have any. The outcome is pretty predictable. The system survives, but your savings get trapped or devalued.
Okay, look, understanding all this isn't about becoming paranoid or stuffing cash under your mattress. It's about becoming resilient. And that requires a really fundamental shift in how we think about our money. We have to move from a mindset of just having access to one of true ownership. So what do you actually do? The strategy is all about diversification. It's about survival. It means having your assets in different forms, maybe some real estate, some gold, whatever, having them in different institutions. And yeah, it means keeping a reserve of physical cash. It's all about understanding that purely digital access is incredibly fragile. If one door slams shut, you want to make sure another one is still open.
And this is so critical for our modern world. We think all our cool fintech apps and our tap-to-pay systems have made us safer, but they've actually just deepened our dependence on this fragile system. In a society that's going cashless, a bank shutdown isn't just an inconvenience. It's an off switch for the entire economy.
So if you take away just one thing from all this, let it be this thought right here. The numbers you see on your banking app, they represent access to money, an access that is granted to you by an institution. They do not represent true unconditional ownership. And understanding that single distinction is the first and honestly the most important step you can take toward building real financial resilience in what is a very fragile world.